Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
I'm flying when you're having fun. I'm having fun. You having fun? Nick, you having fun? Yeah, you're all right. He's just dreading the night. He's working late. You're working a late shift tonight, aren't you? Yeah, you'll sleep well. Yeah, you'll be out after you finish tonight. Yeah, that's what happens when you're a rock star. Yeah. Okay, so anyway, there has been some interesting stuff going on. You know, I've talked a lot about, you know, the idea where investors are a little bit complacent in many ways. You know, like if you look at the default choices in your 401ks, a lot of the default choices are going to be, you know, typically you have a couple things to choose from. One thing is, am I going to do this 401k pre-tax? Am I going to go post-tax? So pre-tax is where you have $1,000 you're going to put away for your retirement, $10,000, whatever. And then you're going to put that money away, and are you going to take the tax deduction? So if you're in a 22% tax bracket, let's say, and you put $10,000 away, it saves $2,200 in taxes right now. You know, because if you didn't do that, your $10,000 would turn into $7,800. It would be the $10,000 minus the $2,200, which is 22% of the $10,000, and you'd have $7,800 that would come into your paycheck, right? And, you know, you don't get the deduction for your Social Security with your 401k. You only get to avoid the income taxes. And if you live in a state with a state income tax, you know, that too. But, you know, for Tennesseans, we're looking at just federal income taxes. Now, that as opposed to, you know, if I do a Roth, then I have to pay those taxes now, but then I don't have to pay taxes ever again on that. Now, I've talked about that a lot. You're really looking at the differential between what your tax rate is now and what it's likely to be in the future. For a lot of people in the listening audience, especially older people that are maybe a little bit behind on retirement planning, pre-tax quite often ends up being the better deal for them simply because they don't have enough saved for retirement. They're not going to have enough income in retirement to get them in a higher bracket than they're in right now. You know, if you're putting the money away and avoiding 22%, then you just have to be in a lower average rate, you know, in the future for that to be a better deal. And with the tax law change that just happened where we actually extended the tax cuts, that makes that even more the case. There are a lot of financial firms running around telling people convert to Roth IRAs, you know, and they were telling people to convert all this money and doing it in their radio shows and in their broadcasts and their TV shows and all those types of things. And I was just shaking my head and going, this you're taking a huge risk. Because there is an impetus to actually extend this stuff, and it was on both sides of the table. It wasn't just Republicans, it was Democrats who were actually looking at that because nobody likes to increase taxes on the constituents, especially as they get older and especially when they want to get reelected. It wasn't a real popular idea to let that die, but they were pushing that like crazy. And the financial firms are, you know, they sound sophisticated when they're giving you this type of tax planning advice, but a lot of times it's very short-sighted. But if I am likely, let's say that I'm in a first job, I'm young in my career and I'm back in a 10 or a 12% tax rate, you can make that case. Actually, there was a young guy earlier I was talking to, and he said, what would you do? And I said, well, in your situation, I would go Roth. You know, simply because you're likely, and I knew his trajectory was very good as far as his future. And the other thing that you have to look at too, and sometimes I'll ask people is, what's the likelihood of an inheritance? You know, are you going to get an inheritance? Are you likely to get an inheritance? Because especially if you're getting inheritances of IRAs, pre-tax IRAs, that could drive your tax bracket way up in the future. Or, you know, you're going to end up with more money in your 401k as a result of that or something like that. You could have a situation where you're in a much, much higher bracket in the future. So you do have to be really conscious of a lot of different things when you're making these types of planning choices. Now, that's one thing is, you know, what are we looking at as far as that goes? Now, the other thing that we have to look at is how we invest the money. Do we actually use the default choices at our workplace plans? And for a lot of people, you'll have target date funds. I'm retiring in the year 2045, or retiring 2050, 2040, 2035, whatever. And I just choose the default choices. And a lot of people have done that. And you look at the big fund companies, and there isn't an exception. I don't care who you look at. You look at American funds, you look at Vanguard, you look at Fidelity, you look at T. Rowe Price, you look at whoever. You will notice, Voya or whatever, you'll notice that their target date funds are very, very concentrated in bigger companies. And the reason for that is that it's an area that has done well recently. And because people are sucked in by recency bias, what just happened recently is going to happen forever. And it's just, they don't recognize that stuff changes all the time. You can go 20 years with no return in large U.S. stocks. And people forget that can happen. So what has really driven a lot of stuff recently is what? Technology. Look at the holdings of S&P 500 funds and look at the holdings of target date funds, which, S&P would be the bigger holding in that. Like Vanguard has their target date fund, and they have two funds that are those are your stock funds. They've got a total U.S. stock fund and a total international. Well, what's at the top of the heap as the biggest holdings in both of those stock funds is what? A lot of tech. You've got a lot of NVIDIA. You got a lot of Microsoft. You got a lot of Apple. You got a lot of Amazon. You got a lot of these bigger tech companies in there. So you go, well, what could possibly go wrong? Well, what could possibly go wrong is all of a sudden those areas of the market start coming down. Well, how about the people that actually run those companies? Have you ever thought about who runs those companies and how a lot of their pay is done? You have typically salaries, right? A small salary, but a lot of the pay of executives, corporate executives, is in the form of stocks. Stock options, are particularly a big deal because a stock option, what you can do is you can align the interest of the CEO with the shareholders. So if I have a stock option, I have the option to buy the stock at $30, let's say. And let's say that the stock is selling right now for $28. Well, it's out of the money because, why would I buy it for $30 if I could buy it for $28 in the open marketplace? But if I can get that stock to go up in value, if I can get it up to $40, so let's say that I get it to go up to $40. Now I'll exercise the option, buy it at $30, sell it at $40. So that's the idea behind different types of it. Now, there are all lots of different ways this is done, okay? But this is just one way. And you'll have options as a way of paying these people because that incentivizes them to try to build the stock price, and therefore the owners of the company, you, general public, and the shareholders in general all over the world, it makes them happy with the CEO if they can increase the price of the stock. So it aligns the interest. So what's going on right now with people that are running these big tech companies? What are they doing? Well, check this out.
Welcome back. Of course, record-setting year for stocks. Also seeing more insider selling. And Robert Frank tracks that along with so many other things. You track so many things for us, Robert.
It's insider selling?
Wealth creation.
Yes.
When you sell stocks, you get wealth creation. And we've had, obviously, stocks at an all-time high. Not surprising. People are taking cash off the table.
Now, is this everybody? Who's selling? You just got to think about who's selling because it'll make you a little bit nervous if you only hear that insiders are selling. Okay, so hang on. Keep listening.
Insider sales this year, in fact, topping $70 billion. That is the highest total since 2021 in those market peaks. Now, most of these sales are, of course, in tech, with the big tech stocks all powering new highs recently. The number one seller so far this year, not surprisingly, Jeff Bezos. He has sold just this year over $5 billion of Amazon stock. That includes $735 million on his wedding day.
Now, you got to be pretty convinced you need to do something if you do it on your wedding day. Otherwise, I don't know. Maybe he's just going to be really big in trouble with his spouse to be if he's done that. But I think it's just listen what he's saying right there. Now there are different reasons that CEOs will sell. I'll never forget when this is, so don't read too much into this, basically what I'm saying. I remember on this show many, many, many years ago talking about Bill Gates selling. And what I did is I talked about this a lot on the show. I said, was he buying? He was actually taking the money out and he was selling Microsoft stock, but he was buying other companies to diversify himself, which is not a terrible idea by any stretch of the imagination. Now, did Microsoft continue to go up? Yes, it did. So it wasn't really a good move if you're only looking at making more money to have sold. But I think it's really important because, you look at this and say, well, a lot of these people are selling and, there may be some that are selling because they're looking at it and going, it's a little bit frothy, but just recognize that if these people are selling, maybe just pay a little bit of attention.
So paying for that ring and a lot of that wedding in Venice back in June, he filed a 10b5-1 plan back in March to sell 25 million shares this.
So anyway, that's just the point right there. Just recognize, and the point that they made on the show right after that, I don't have the audio of it, but they were talking about how that there has been a tendency for some of these tech people to be fairly decent at, when things are near highs to actually move out. But just recognize that when you're managing an investment portfolio, this is part and parcel of what you're doing anyway. So if you look at when markets were hitting highs or their S&P 500 or large companies were hitting highs, it wasn't, when in managing it that I went and said, hey, we got to have sales of everything or like that, or where we're moving everything out of that area. It would be just, let's say I was supposed to have 5% of my portfolio in large growth companies, and it's sitting at 8% because that area had just done very, very well. So you say, hey, it's at 8, it's supposed to be at 5. Bringing it back down to 5. Now that is better judgment as far as, if you look at the prudent investment rules and how you manage a portfolio, it's better to manage things in that particular manner rather than try to figure out what's going to happen next and move money around. Because here's what happens. This is what happens with the investment industry. Is something else that I had pointed out to all the folks I work with, all the different investment advisors that I work with at the offices around Nashville. I said there was an article where there was, and let me see if I can find this. It was an article that was talking about a fund company, and let's see if I can find. I think it might be it right there. Yeah, that's what it was. Okay, it was investors are turning to this neglected part of the stock market, and it's still cheap. So I'm managing an investment portfolio, and I'm looking at around. I'm going, hey, this area of the market's a little bit high. What should I do? Now, my instinct would be, hey, what's selling for a low price? And that's literally what they're trying to drive people toward here, right here in MarketWatch. Said over the past month, there have been many warnings that the stock market, particularly the S&P 500, may have reached a stretched valuation. And that's compared to, corporate earnings, because we're buying rights to earnings when we buy stock. I'm buying the right to receive the earnings going forward. But the story is different with small cap stocks that have sprung to life over the past month. They said here it returns 7.5%. So that just depends on the area of the market. There have been other areas, like if you look at so far this month, somewhere in that neighborhood, microcap stocks, about 7.6% return. So I checked out, my portfolio and go, yeah, about right, about 7.6% return. Small value, actually even better. It's a little bit over 8%, but a lot of times people don't see that in their portfolios. You don't have that. If you look at international small companies, so far year-to-date return for that asset category is up 37%. So it's just different areas of the market would have different returns. But here's the point. They're just saying that small company stocks have sprung to life. And they says we have left the Russell 2000 out of this comparison because this index includes hundreds of unprofitable companies. And the forward PE ratio is meaningless. In other words, if you have a bunch of companies that don't have any earnings, looking at the price to earnings is kind of meaningless. Now, here's the reason that's important, because they're talking about which index to look at. I actually talked about a few months ago, because a lot of people will buy mutual funds and they'll hear me talk And they'll say, oh, Paul says we don't just need to have money in large company U.S. stocks. We also need to own small. We also need to own small value. And what they'll do is they'll just find an index fund that invests in that area. And the point that I made on this show a little while back, it was probably, 2-3 months ago, something like that, is how different these indexes are. You may go to a mutual fund company, a Vanguard, or a Fidelity, or a T. Rowe Price, or whoever, and you'll find a fund that says it's an index fund that tracks small company indexes, but not recognize what index they're tracking. This is absolutely key because you can have huge differences in returns. And, I don't think they were thinking about that whole lot right here when they wrote this, but they said we left the Russell 2000, which is a small cap index, out of the comparison. Now, they may have included it in previous articles. I don't know, but they left it out. Why? Because it had such a different return from another index. Another way the financial media gets you looking at, hey, what just did well recently? Hey, what just did well? Certainly not the Russell 2000. So what do? Let's just ignore it when we're trying to make a case as to why you want to invest in this area of the market. I don't know if you're getting what I'm saying, but it's insidious the way the financial media and the investing world tends to drive investor behavior. But anyway, I'm going to go on. S&P 500 is trading at a forward PE ratio. In other words, what do we think the earnings are going to be over the next year? That's what forward PE ratio is. We're not buying yesterday's earnings. We're buying what the earnings are going to be going forward when I buy a stock. And it's sitting at $22.45. And what we expect earnings to be. Now, that historical norm is about 16, just to put that in perspective. So if we look at it, it's about 38% higher than its 20-year average valuation. That's a pretty big difference. Says the S&P small cap 600 trades at about 15 times earnings, which is more normal. Well, you got some areas are sitting at about $10 compared to forward. So there are a lot of areas that are not overpriced by any stretch of the imagination is the point here. Now it says you're probably familiar. This is the point I want to get. This is why it drives me crazy about mutual fund companies and the way they manage your 401ks and target date funds and things like that. You're probably familiar with the old 60-40 portfolio. As if it's an old adage and you don't need to pay attention to it anymore. I've talked about this a lot on this show and how, the investment industry loves to embrace this, walk away from it. Embrace it, walk away from it. They are about as disciplined as gnats when it comes to managing money. They're really bad. Because you ought to do this. No, you ought to do that. No, you ought to do that. And I'm like going, no, make up your mind. If I am investing, changing my investment strategy all the time is counterproductive. It is by definition market timing. It is by definition tactical asset allocation, which is market timing in disguise. And the way I remember 25, 30 years ago, this is the way I would teach this. When I would go around town here, north of Nashville, Goodlettsville, and I would actually teach workshops all over the place. And I would use this analogy. I would say, is it more dangerous when you're playing Russian roulette with one bullet in the gun or 6? And people are like, well, Paul, yeah, obviously 6, right? And I said, okay, now I want you to get that market timing is normally thought of this way. I've got stocks and I've got cash. If I think stocks are going to go down, I'm going to sell stocks. I'm going to put my money in cash. If I think cash is going to do better, I want that in my portfolio. I want that to be the main thing that I hold. I mean, it makes sense, right? If I believe the stocks are going to go up, I'm yanking my money out of cash and I'm dumping it in stocks. That makes a lot more sense, right? Let's make sure we engage in this rally. Now, market timing in its purest form is that. I've got stocks over here, I got cash over here, and I'm going to move back and forth based on what I think the market is going to do. This is what the industry really does. And when I have read prospectuses, I've read ADVs, disclosures by investment firms, and I've done this on the radio before many times, you'll see tactical asset allocation. You'll see that they'll do fundamental analysis. you'll see that they'll do technical analysis, another form of this. It's right in their ADVs. It's right in there. They're telling you they're going to do this. And what they engage in, tactical asset allocation, is this. I've got a little bit of my money in this area of the market. I got a little bit of money in this area of the market. And I might have 10% here and 10% here, for example. And I think, based on my research, that area A is going to do better than area B. So I'm going to put a little bit more money in there. Now, number one, if they are so stinking confident that they know where things are going to go, why don't you put everything in area A? Why would you do that? Why don't you put everything there if you're so confident? And that's playing Russian roulette with lots of bullets in the gun. It's a lot more dangerous. I know it's a gruesome example, but I just want you to get the idea that tactical asset allocation is market timing in disguise. And that's exactly what they're engaging in. And that's what they said in this article. They said this week, Barbara Kohlmeyer interviewed Todd Schlanger, a senior investment strategist. Now, this is a senior strategist. Apparently, a person's been around the block a little bit with Vanguard, who made the case that some investors, based on current market conditions, hear that, based on market conditions, based on what's going on right now and their investment goals, should embrace portfolio allocations that are 70% bonds and 30% stocks. What are they telling you to do? Market time. Tactical asset allocation. Now they're getting even worse. They're doing the primary form of it here by moving more money in one area, stocks, moving it away from that toward fixed income bonds. Now, what do we know from research? We know if we look at the pension funds, not one, that Brinson Hood-Biebauer study, out of 91 pensions, how many of them increased returns using these strategies? 91 pension funds. How many of them increase returns? 0. Not one of them. It tends to increase risk. It tends to reduce returns. And yet this is what the investment industry does, and you don't even know it's happening because you've blindly trusted them. I got a problem with that. Obvious problem with that. But all I can do is educate. And I'm going to keep going until I'm blue in the face, and I'm getting there. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. I had totally forgotten about this. I had actually an audio clip on what I was just talking about regarding the investment industry market timing. There was something that they were talking about retail versus institutional market timing this week on CNBC. Yeah, that was
high. It's pretty much, Robert, since we got out of the Liberation Day fog, haven't really looked back.
And there are so many reasons to be skeptical of this market. I mean, I talk to family offices. Of course, they're different because they have much longer time horizons. They're looking through a lot of what they say is these short-term issues. But I think among the investors I talk to, the big family offices, big high net worth investors, they have been skeptical of this market because of the concentration risk and because of the valuations for a long time. And they've lost a lot of the upside because of this. But not a day goes by when I don't talk to these investors and they say they're either shorting this market or they're certainly staying a lot into illiquid alternatives. Now,
remember, I've said this before, that big investors, just because somebody's wealthy doesn't make them a good investor. So they're just saying that they missed a ton of upside with what they've been doing because they've been market timing. The wealthy people have been market timing, and I've talked about that over and over. Don't follow what wealthy people do. People think, oh, they're wealthy. They must have gotten that way through having great prowess when it comes to investing. And no, that's not true at all, as they just pointed out right there.
Say they're either shorting this market or they're certainly staying a lot into illiquid alternatives.
So shorting, you're betting that the market is going to go down, and they're talking about illiquid alternatives. So remember, I've talked about that in the past few weeks, watching out for alternative investments. Just because they've made it something that you can have in your 401k doesn't mean it's a good idea. Now, typically one of the ways to avoid alternative investments right now, because they're only being used in some of these target date funds, that's where they're actually going to start opening up and you're going to start seeing them there. One easy way to avoid it is to avoid those pre-allocated portfolios in 401ks and just because typically you'll have other funds that you'll have access to. Now, sometimes I've had where we allocate things for people and I've had nothing else that I could use other than those pre-allocated portfolios in conjunction with some of the asset classes that they're missing. So in English, what I'm saying here is that if I have a mutual fund that's a pre-allocated, like a target date fund, remember I said that they're overweighted in what? Large U.S. stocks. They're underweighted in what? Small U.S. stocks. They're underweighted in value. So typically what I'll do is I'll go in there and I'll look for small company stock alternatives or value alternatives, and I'll beef up the portfolio by adding that. So, and I have been known to take a target date fund and just add to it those other asset categories that are missing. But if I can, I like to try to build the portfolio from scratch with other types of things that I have access to. That typically tends to be what I want to do. But they're talking about shorting right there. They're saying, well, they're going to short. Well, you better be right, and you better be right in a certain time period for shorting to work. Remember the whole thing with GameStop. That didn't work out so well for people when they were shorting, and the stock didn't go down in the time period that they were hoping for, and they lost their shirts when it got down to it. But anyway, so that's one of the things that they're doing right here is they're making that move right now.
They think will be less volatile than what we're going to see in the stock market.
It has been. I mean, I think when at the end of the year, David, when people sort of write the story of markets in 25, it's going to be about retail holding the market's hand as opposed to institutions and being proven right for now.
Yeah, well, certainly during the...
And so basically what he's saying is the big investors that are managing so many of these pension funds and these 401k plans, they're just losing discipline. And it's just like what I was just talking about. It happens so often. And then you're having the retail investor, and this is what I often find when I talk to just the general public out there. They're like, I'm not panicked. I'm not worried. I'm just not doing anything. And I'm like, well, the problem is the fund company that's managing the money, they're panicking. They're doing all kinds of things. You don't even realize that they're doing it. You have to really watch them like hawks.
Tariff tantrum back in early April. I think we've gotten data that indicates many retail investors hung tight, whereas a lot of institutions that we know, and certainly ones that I speak to, were taking down risk, as they like to say.
Yeah, that's a euphemism. I'm taking down risk. I'm market timing. I'm pulling money out of the stock market after it goes down. I'm taking off risk. You're actually increasing risk, which is kind of funny because of the euphemism. Just try euphemistically saying that I'm taking off risk and I'm avoiding it. It's just sad. It's sad, and most investors don't even realize that it's happening. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.